The dollar relation to the gold is a very pathetic. Dollar index we're talking about now. That's merely the dollar measured versus several other fiat currencies. So it's a competition of which piece of paper is more worthless than the other. Okay. And the varying issue. Okay. So versus the euro and the yen, which constitutes 70% of the dollar index, the dollar index is very weak. In fact, right now, yeah, you're at 98, 99, but you collapsed. We got bearish a year ago in March at 104.50. It dropped down to 97.890. It's been doing this for like 3/4 of a year, mostly below 100. Doesn't matter. Momentum, long-term momentum is fully broken with trend structures going back a decade and a half. So momentum says you're gone. Price is the one that's trying to hang in there. And every time there's an uptick, people say, oh, the dollar's strong. If you go back to 2015, when gold made its low in December, at 1,050. Where was the dollar index then? That's where it is right now. So if you didn't buy gold at 1,050 and it's now fourfold, and your excuse was the dollar, then you missed a fourfold move in gold because the dollar index had nothing to do with the trend in gold. It's merely its competition to other degrading currencies. Okay. I think the dollar is likely to have another wave down of huge proportions, like get down to 70 and so. But that's really not a prime mover for gold. The degradation in the dollar and the yen and the euro and the pound by constant monetary expansion is an ongoing motor underlying money, silver and gold. And that's likely to increase because of this government debt crisis. So the government debt crisis, regardless of the better yields, is indicating instability, uncertainty in that asset category, which means if you're smart, you don't put your money in there to get the yield. Something's wrong here. You got a borrower that can't pay, so he's going to print it. Okay. CPI is merely a reflection of inflation. It is not inflation. It's the increase in the money supply ongoing that's inflation. And it shows itself in stock prices, commodity prices. And when your granddad built a house, it was $4,500. Your father, it was $45,000. If you want a median home today, it's $450,000. That's called inflation. It's reflected in everything, including the stock prices, including gold prices. Some will underperform that. Commodities have vastly underperformed the rate of degradation in the money unit. The S&P has reflected it. If you go back to 2000 to the present and look at M2, how much it's grown, percent, S&P has grown the same percent. So all the S&P has really done is go ho-hum for a quarter century in terms of real buying power. You've not made money. You've made nominal money, but it's because of a degrading money unit. So gold has vastly outperformed it. And silver is about now to leave the page on that issue. Okay. So right now it looks like that flipping of asset preferences, which investors control, the Fed doesn't control it, is going to shift from stocks into the cheaper stuff. And oil's one of them. Even after the recent surge, it's still cheap. And commodities is a category. So anyway, that's my assessment of that. Inflation is not that. Okay. Even JP Morgan a couple months ago said 9,200. Okay. And all the banks that come out with reports and are bullish on it, they always, every month or two, they'll up it by 1,000. They're okay. Gold twice in its history since it was legalized in 75. It's had two bull markets. Each of them was eightfold move from bear low to bull high. Our bear low was 1,050. You do the math. So something like 8,500 would merely match the dimension of the bull market that peaked in 2011 or the one that peaked in 1980 in terms of multiple gain from bear low to bull high. So that would merely be, ho-hum, I did it a third time. Well, so JP Morgan's assessment, I didn't even read it, but I saw the conclusive number, it was probably fundamentally based, was 9,200, which happens to be in that ballpark. I don't think gold will stop there. I think the crisis we're facing will take gold to some level that I can't predict. I don't have a target, except to say a lot higher. The one I'm most focused on is silver, because I think silver could go absolutely parabolic. And it shake enough other assets that people have been comfortable with because the Fed's been printing the money and making money free for 10 to 15 years. You look at a Fed funds chart, go back 75 years, you can get it from St. Louis Fed, and you've either been at zero or you got up to all of 5% or so, and then back down to zero, and then back up to 5. But if you look at that 15, 16-year history since 2009 and compare it to the other 75 years, it's a joke. It's like off the page cheap. Money has been made artificially cheap for a decade and a half plus, and therefore the liquidity flow went somewhere. It happened to go into stocks. But as soon as the investment public and asset managers realize, it's not working anymore for stocks, it's working over there in the price of commodities or the price of gold and silver, I'm going to shift my money over there. And so when the stock market wobbles, that will be a further fuel, one for the Fed, because it'll create some data points for them, but for fuel of money moving that the Fed prints into the monetary metals where it's protected. And I think that's why you got to watch the bonds because they could impact the stocks. If they impact the stocks like we think, by this summer you'll realize, oh yes, the money's flowing from stock to gold and monetary. You mentioned year to date in the stock market and gold, for example, but if you go back a year to date, May 15th, last year. Silver, I just did the math before we came on, 137% up. So gold, 40% up. S&P, 25.6%. So monetary metals year to date, May 15th to May 15th, is up a lot more than the stock market. So lately, yeah, the stock market's had this goose. That's fine. We love it because we don't want the market to top with negative news. We want it to be in a happy phase and then top. Your question was again, silver. Silver,
Yeah.
Silver, I'll give the story again about copper. Just one example of many. They're rare, but they do occur. Copper was stuck in a price range for multiple decades, between 50 cents and $1.50. 1970s, 1980s, 2000, 2005. In late 2005, copper decided to move up out of this old reality, 50 cents to $1.50. And when it crossed to $1.50 in late 2005, within several quarters, it was $4.10. Wow. No headlines. It was peculiar to copper. It didn't happen in all the other base metals. It wasn't because gold was exploding at that same time. It was copper went berserk. And then, yeah, it had sharp sell-off after that peak, but it lived in a new range around 350 for decades, a couple decades since 2005 to 2020 something. And 3 to 4 times the price of its prior average multi-decade price. But when it did it, the point is it did it in an emotional burst. Lead did the same thing in 2007. It had a similar chart type situation. Exciting metal, lead, okay? Silver had the same pattern for 50 years. Gold kept taking out every high. 1980, taken out in 2011, took it out again. But silver still capped at 50 through late last year. What's going on there? I mean, it's a monetary metal. Copper already blew out its multi-decade highs. Lead did. Gold did. Why is silver contained in a box? Well, it decided no more. Now, let's forget the reasons. Maybe it's manipulated. We know there's been a lot of that, institutional manipulation. But the market said, no more. I'm out of here. And usually when markets get overpriced at a high, they go down more than they should to correct. And when they're underpriced at a low for too long, when they correct to the upside, they quite often will go maybe twice as far as they reasonably should in an emotional burst, like copper did. We measure silver on a logarithmic scale instead of an arithmetic normal dollar price chart where, already it's more than doubled. $4 to 50, you add $45 on top of 50 and end up with 95. So when it got to 95 late last year, that doubled the dimension of that range. But when you go to a logarithmic scale, which is the best way to do it, copper, for example, back then, when it went from $1.50 to 410, went up to a ratio scale dimension beyond the prior reality. Silver, if you do the same thing, you had a range from $4 to 50 repeatedly. Well, that's like a tenfold dimension, $4 to 50, right? A little more. What's tenfold above 50? 500. And when you do a monetary assessment, what's the money supply versus where it was in 1980? What's the money supply now versus 1980? On 2001, silver would be up in that range, 3 to 500, just to catch up to the money degradation. Also, for silver to catch up to its relative value to gold that it's seen over the last half century. In 1980, it was 6.5% the price of gold. 2011, it was 3.1. Well, right now you're still below 2, so it's still cheap. It's broken out. That spread is broken out, favoring silver, and that's why silver's done better over the last 12 months by far than gold. Like I said, up 130-something%, gold's up 40-something, okay? The next phase should get silver, I think, in a tantrum mood and level, probably within 3 or 4 months. The issue is to break up out of this consolidation. It's a violent consolidation zone. I think we're in the process of that right now. I still think it's quite reasonable. I can come up with it so many different ways. And this pullback that we had measured by our momentum trend metrics, it spooked a lot of price people. In no manner did it jeopardize the long-term momentum trend that we measure using quarterly momentum or annual momentum of silver and gold. Weren't even threatened. Okay, especially annual momentum. Whereas at the 2011 gold top, for example, a mere $100 or so off that high, annual momentum blew structure. This time, it didn't break any structure in the drop. The only break you had in gold and silver were intermediate metrics, meaning metrics that when they break, they're worth a couple months of downside or wasted time, which is a stumble. It's not a major trend change. And those have now dissipated. And silver is now leading gold up out of the hole recently, and percent-wise from the March low, for example. And I think that silver is now leading us up out of here. And I suspect this pullback you're seeing right now is about to end either today or Monday, and you'll go back up again. The price guys will start to wake up. They don't look at momentum. They don't know about that. They don't know how to use momentum the way we do. But when they look at a price chart, you've had 4 rallies, I think it is now, including the recent one, up to $90. They sell it there, they sell it there, they sell it there, they sell it. You don't make a top that way. You don't keep coming back to the same distribution. I mean, that's persistence is what that says. And particularly what silver did in March was really bullish because it took out the February price low. If you recall, that sharp break in January, February stopped at $66 on silver. We shot back up to 90. We lived in a range. And when the war came out, in early March, we had a sell-off again in silver again and gold. They both went down and they knocked out that low, the Feb low at 66 on silver, went to 61 for about 2 hours. That's how fast it was. They broke the low, ran all the sell stops, goodbye, and immediately reversed and shot back up into the range like, ha ha, fooled you. Okay? It was a bear trap. And I think that was the low, the March 23rd low at 61. And I think now you probably got support right around where you are in the mid 70s. And all you got to do now is inch back up again toward those highs. The high we saw this week, $90. And you're out of here. That's when I think you see that acceleration phase.